there are multiple periods over the past half century where stocks didn't go anywhere for 13 to 16 years. If you want to look at 1966 to 82 or 2000 to 2013, there is going to be another environment where there's a decade or more that we're just kind of in these ups and down swings. And it's important to try to figure out what's the right way to manage that rather than just thinking that the buy the dip mentality is always going to work. It's been working, but it's not going to work forever.
Volatility remains the name of the game. Last Thursday night, Israel struck Iran. And now there's a developing situation that Iran is striking back. Well, we'll get our outlook for the markets and how investors can respond to geopolitical tensions with our next guest, Chance Finucane, CIO of Oxbow Advisors, and we'll also be getting his analysis on the current situation regarding the trade war and whether or not developments there could impact portfolio allocation strategy. Welcome back to the show, Chance. Good to see you. Always good to have you back.
Yeah, great to see you, David.
What was your initial reaction to Thursday night's news after tensions broke out between Israel and Iran after the initial airstrike by Israeli forces? Oil spiked in the news, gold spiked, Bitcoin down, stocks down on Friday. What was your reaction? Did you do anything in terms of portfolio allocation and repositioning?
No changes to our portfolio allocation. Our managing partner, Ted Oakley, and I were actually talking about it on Friday morning after seeing the attacks occurred overnight. And we already had positions in the energy sector. We've got a lot of exposure to oil, and that's something that rises when an event like this occurs. Although if you looked at the trading activity on Friday, June 13th, you saw the price of oil go up by $8 or $9 a barrel, 8 or 9%, but the energy sector stocks only went up by less than 2%. So that would suggest to us that everybody's seeing this as sort of an acute event in the short term, but not something that's going to permanently raise the price of oil into the future. So it's something that we monitor. Just talking it through, when Israel did this to Iran in the past, Iran did not retaliate. So we'll see if there's a retaliation and if things expand, that might have a larger impact on markets overall, and kind of speaks to the way that we like to approach things, to always make sure we keep some liquidity, keep our portfolios flexible so that we're able to adapt and adjust as fast as possible when something like this occurs, because we are not geopolitical experts. We don't know or try to make forecasts on this, but we want to be able to adapt the portfolios if something significant happens.
Is this kind of a sell the news kind of event where after the fact you can expect sort of a sell-off or reversal of trends, or is this the start of a larger trend where we have to start repositioning for more geopolitical tensions, do you think?
It's really hard to predict that. I don't think we're trying to make a call either way. You'd probably say like this probably fades back a little bit more into where things were trading a few days ago if tensions start to calm down in the weeks and months ahead. But I think we really want to make sure that we've got a balanced, diversified portfolio for our clients that can withstand something like this happening, and we're not coming in panicked the morning afterwards trying to wonder if we need to do anything. Our activity today was pretty calm.
Lockheed Martin jumped 4% on the news. Are you interested now? We're more interested in defense stocks?
We've got a position in Lockheed Martin in our stock portfolio for clients in the long-term growth strategy, and that's one that we've had for a while and we plan on keeping. When we look at the defense stocks, those tend to trade in a pretty consistent trading range on valuation multiples, and they tend to grow at a somewhat steady rate, mid to high single digits in their earnings growth over time. So it's really a space that I realized earlier in the year, especially the European defense stocks, really caught a bid and they went up a lot in value. But we almost think that's an over-anticipation, and we're not going to chase that, because when we've seen that happen in the past, such as the bidding up of some of the U.S. defense stocks when Russia invaded Ukraine in 2022, they went up a lot, but then there was a reversion to the mean. So we like having some exposure to the defense area, but we're not going to chase it on a day like today. Either we're already positioned for it or we stay out.
Okay. Now, Chance, let's take a look at the trade war. So, like I mentioned in the introduction, the agreement between China and U.S. has been reported to have been met, meaning I think there's now a de-escalation in the trade war fears. Is that still a narrative that you're following as an investor?
We follow it, but what was most interesting to us when that announcement came out was that the market really didn't react that much, which tells us that you see how much stocks have rallied since the bottom on April 8th. We think a lot of that news for some sort of a reconciliation between the US and China, along with other trade deals that need to be made, is already being assumed that it will be completed. And when we look at, there's markets for this where people can try to bet on what the final outcome on a tariff rate will be. And right now, if the average tariff on the US against China is somewhere around 50%, it seems to be that everyone expects it'll settle somewhere around 25 to 40% as a tariff rate against China. We'll see. The thing that's more intriguing to us is that what is already priced in the market, and that tells us that everyone's back to thinking pretty bullishly about the future for risk assets.
Okay. And gold has spiked overnight, like I mentioned, nearing $3,500 an ounce. Not surprising given the geopolitical events in the Middle East. How are you positioned in regards to gold? Is that something that is that an asset that you think has more legs right now, whereas $3,500 you think the absolute resistance level?
We've been bulls on gold and silver as well. You could just say we've been bulls on precious metals for several years now and continue to hold that. In our high income strategy, it's almost 10% of the portfolio, either allocation to precious metals themselves or companies with exposure to precious metals. And that's an allocation that by and large we want to keep. We don't know that at some point we thought when gold reached $3,000 that there might be a pullback in the short term just because it's had such a good run higher. Now you're getting towards 3,500. At some point there'll be a pullback, but we're not trying to capture the swings in the interim. We just know that given where we think things are headed over the next 5 or 10 years, we think that's a good allocation to have for a portion of the portfolio, and we're not going to mess with it too much.
When you say where things are headed over the next couple of years, what are you referring to exactly?
Well, our stance for the last handful of years is that the environment we had from 1982 to 2020, where you had falling interest rates, falling inflation rates, globalization was a help with that. You saw profit margin expansion because of falls in interest rates for companies, falling tax rates. We've seen some of that shift where we think for the past 5 years, you've got rising interest rates, and that could continue, or at the very least have more of a normalization of interest rates. And part of that is we think inflation is going to be a bit stickier going forward. So we think that is a conducive environment for gold if the purchasing power of a US dollar, if you live here, is going to be continue to diminish. And if you just look at government activity, the deficits we're running, how that could continue going forward, you could end up with a situation where gold continues to look relatively good, and we think that's a valuable asset to have.
Are you sharing similar sentiments with any other stock sectors right now?
Yeah, I'd say if we just look at what we've been doing the past couple of months, in the high income strategy, incrementally, we've been adding a bit to precious metals. We had been adding a bit to the energy sector, got incrementally more bullish on that. I think we sort of assume a normal price for oil is somewhere around $65 to $70 a barrel. And so when we see it dip down to $60 or slightly below, like it did earlier this year, we still think there's going to be higher inflation ahead. When you look at the rest of the decade, that's a time for us to incrementally add a little bit more. So we were doing that. And then in the long-term growth strategy, the stock portfolio, we talked recently about maintaining our exposure to healthcare. We think there's an opportunity there over the next multiple years for it to outperform the overall market. And then outside of the defensive sectors that everybody really focuses on, we've been trying to prioritize resilient businesses that we think the cash flow visibility is very high in case we get any sort of an economic shock. We're back to record valuations. We want to be in things that we think can hold up well if there is another down market ahead. So been adding to things like Otis Worldwide, which is the leading elevator manufacturer in the world, with very sticky cash flows, maintaining those elevators for their customers, and Yum Brands, which is one of the best run restaurant chains in the world that just collects royalty revenue from all their stores and has a lot of visibility.
Well, What happens if inflation gets out of control because of tariffs? I'm not saying it will happen. I'm just outlining a scenario that some investors and economists are concerned about. Suppose we have a return of high inflation. How would that change your allocation strategy?
I think we're already somewhat positioned for that. Not that that's our forecast or what we think is going to happen, but because we have a balanced exposure across different asset classes that we think is important to have, there are going to be portions of each portfolio that are going to perform well in that scenario that you're outlining. So gold and precious metals would probably hold up well in a high inflation environment. Oil, energy stocks, that would do well. And the overall stock market for businesses that are capable of raising prices to keep up with inflation, those stocks will hold up well. They may not generate a great real return adjusted for inflation, but hopefully you'd be able to hang on to your purchasing power. On the flip side, the risk would be on longer term bonds. If interest rates really rose a lot in an inflationary environment, we have stayed away from the long end of the bond curve. We are really focused, any fixed income things we have are primarily maturing 2 years or shorter.
I think you've mentioned in the past that Oxbow reduces cash positions when attractive valuations emerge. In other words, you deploy more capital into the markets when valuations become more attractive. Let's assess valuations today. The S&P 500 was nearing all-time highs. We've come down from 6,000 points. Is now a good time to deploy more cash into the markets or not?
We would not deploy more cash at this time. If you go back 2 months when you had that volatile decline in early April, we went back and looked at it. We quadrupled our trading activity because we were seeing a lot of opportunities there, and we were buying something new or adding to existing positions nearly every day to try to take advantage as the market kept dropping further and further. The catch was that was such a short time period for that volatility, and then the market shot back up to near record highs today, that you didn't get that long of a period to be able to build out the rest of the portfolio. So we're happy with what we bought a couple of months ago, but now we're back mainly to where we were earlier in the year when we thought valuations were pretty full. And so we'll maintain the exposure we have. We're always trying to find incremental things to buy. And for example, in energy, we're able to buy high quality businesses like Chevron and ConocoPhillips that have 8 to 10% free cash flow yields, which is pretty attractive at a time like this when the overall market trades at a 4% free cash flow yield. That's the sort of thing we're looking for in this environment that's kind of running our own race, and then we don't have to try and play along with the expensiveness of the rest of the market.
Roughly what percentage of a pullback would you need to feel more comfortable getting into the markets?
We started when markets were down about 10% when we were buying towards the end of March and early April. And then we really started to pick up the pace once the market was down 15 or 20% from its highs. So, if the market's back at about 6,000 now, we would start looking again below 5,500. And then when it gets down to like 5,000, 4,800, 4,500, that's where you really start seeing more opportunities that something might have been sold off just because people are starting to get spooked in general, rather than there is a company specific or industry specific reason for why this share price has fallen off.
Bond yields, are we approaching 5% anytime soon in the next coming months?
It's possible. We're not trying to forecast whether that's the case. I think if you're trying to extrapolate it, we do think the inflation rate, which cyclically dropped down to a low at about 2.3% a couple months ago, we think that's trending higher again, heading back towards 3% over the course of the second half of the year. If that's the case, and we've seen real rates adjusted for inflation hang out at about 2%. So if that's the case, if you get 3% inflation and a 2% real rate, you can see the 10 or 30 year hit 5%. And we'll see what that does, if anything, to the stock market. If we just look in the last few years, when the 10-year gets above 4.75, that's usually when you start to see stocks get a little wobbly, but we'll see.
If the 10-year rises now alongside the Fed cutting rates, we can expect the 2-year to fall. So that's steep. That's a steepening of the yield curve. How do you usually, as an investor, play a yield curve steepening phenomenon?
We don't do a lot of that. I think on the short end, the 2 years or less, we're very focused on what's the absolute yield we can receive. And we're really trying to make sure that we can try to get 4%, which as of now gets us about 18 months out. that we can be buying incremental risk-free treasuries for our clients and know that we can get them a 4% annualized return. On the long end of the curve, our look has changed. I think if you look back when rates were secularly falling through up until 2020, we were really trying to be opportunistic and buying when yields would jump higher, assuming that you were going to see yields continue to decline like they had been for 40 years. Now it's the opposite case, where unless we think there's a really high chance that a recession is kicking in which case long-term rates would absolutely fall, even in a high inflation environment, it's difficult for us to see trying to jump in and pick a spot that we'd buy the 10-year or the 30-year.
In your June outlook deck, you discussed S&P profit margins expanding to an unprecedented 14%. Technology was a primary driver, given that the rest of the market shows flat margins. Now, tell us about how this plays out for an investor. Do we need tech valuations to contract before you feel more comfortable, or does the rest of the sector need to catch up? What's at play here?
Yeah, we're not necessarily viewing it as one versus the other. I think when I included those slides in our last presentation, I really just like to let everybody know this is what you're assuming, that the profit margin expansion we've had for the overall market, being the S&P 500 in this case, it's been almost entirely driven by the technology sector, which is really impressive, and it could absolutely continue, but that's the bet you're making. And if you include some of these businesses, they don't put in tech, but are basically technology businesses like Alphabet, Meta, and Amazon, it's nearly 40% of the index that is really, you're making a call on technology. And for us, at least thinking about our clients' portfolios and wanting to know the risks that we're taking on, we want some exposure to technology. We think it's very interesting that they're trying to use AI to make their labor costs more efficient, and that might even increase their profit margins more for the software side of the technology sector. But we want to have more balance than having almost half of the portfolio exposed to one sector. We think that doesn't necessarily fit for our clients, and we just think it's something to pay attention to.
What's your outlook for the S&P for the rest of the year?
It's so hard to predict. I don't think we try to do 6 to 12 month predictions. If you're trying to look at this rationally and just look at earnings growth for the rest of the year, if it came in the way that it's projected, you can see the S&P go up another 5 to 8% in line with the earnings per share growth that's anticipated. But so much of the market movement has to do with sentiment and things a little bit further out, anything happening in the economy or geopolitical events like what just happened with Israel and Iran. We just are looking at what are you paying for, what incremental dollar are you spending to try and buy into the market today. And at 22 times forward earnings, you're paying a very full price, and you better hope that everything comes through as people hope in order to get your 8 to 10% forward return. We would rather say, we'll take some of that, put it in short-term treasuries. We still like what we own, but we want to be available if we all of a sudden think that the market's set up to grow 12 to 15%, then we can really get active and be more opportunistic.
Beyond home builders, which I believe is something that you think is struggling, what else may be struggling or lagging this year?
Well, we just look at things that we've tried to own or we paid attention to. Home builders is one that, because interest rates had been rising and now the mortgage rate in the U.S. is stuck at about 7% for the last few years now. And home builders did well there for a stretch where they were a third of all the home sales, but now it's starting to hit them too because the inventory of existing homes for sale keeps rising, and we're nearly back to where we were in 2018 and 2019 in terms of total homes for sale in the U.S. So you're seeing interest rate affected sectors like that get hit. One other area that we're really trying to monitor, and we only have one position in our high income strategy, is REITs. There's sectors like REITs, and utilities have held up okay, but these are rate sensitive sectors that we're really mindful of, that if rates did keep rising, the long-term rates at 4.5% to 5%, if it goes to 6%, you're going to see valuation multiples for sectors like those compress. And so we want to be aware of what the upside to downside is in those areas, and basically have come to the conclusion that outside of a really good selection we might be able to find, we don't have to play in those areas too much right now. Are
you looking at 2025 as kind of a consolidating year? In other words, the markets have seen this new all-time high earlier in the year. There was euphoria and then a lot of fear around the trade war right after Liberation Day. But now things are kind of just moving sideways a bit. As an investor, are you kind of looking out for major events or catalysts that may move the needle either way, or is this just kind of like a rest year, so to speak?
We don't think we have any edge in predicting catalysts, but we completely agree with you about this being a consolidation year. And we've seen people write about this, that if somebody just had not checked the markets for the last 7 months, they wouldn't think anything too crazy had happened. And yet we've had multiple big swings up and down, but we're basically at the same price in the major indices that we were back in November or December. And I think that's something our managing partner, Ted Oakley, has talked about. I know he's talked about it with you and communicates that to our clients, that we just went through a 16-year period from 2009 to this year where markets just have been in this secular uptrend higher, and we think everybody's gotten used to it. It might continue for years longer, but there are multiple periods over the past half century where stocks didn't go anywhere for 13 to 16 years. If you want to look at 1966 to 82 or 2000 to 2013, there is going to be another environment where there's a decade or more that we're just kind of in these ups and down swings. And it's important to try to figure out what's the right way to manage that rather than just thinking that the buy the dip mentality is always going to work. It's been working, but it's not going to work forever.
Major risks and opportunities that investors should be paying attention to for the next 3 months, besides what we've discussed so far?
Yeah, I think to touch on the inflation rate, I think the most recent inflation report that just came out was a little bit below expectations. And so people viewed that dovishly, like, oh, that's great. We're seeing inflation come back down. The key is the inflation rate, though, is still starting to accelerate higher. And if inflation does go higher, that's going to constrain the Fed from being able to do anything on the rate cuts that investors may want. And we think the only way that you'd see them meaningfully cut rates is if there was a real breakdown in employment in the United States. That's not the case right now. The employment environment is softening, but still holding up okay. But we do have continuing claims back to where they were in 2018. And so you're seeing hiring slow down. People who are out of a job are staying out of a job for a bit longer. It's something that we're monitoring. Right now, it's not our base case. But if that accelerated, that would be something that could cause more issues and cause a more significant market drop. And we're positioned just in case something like that happens.
Are you doing a reallocation anytime soon? How does the portfolio allocation adjustments work at Oxbow Advisors? Is it a quarterly adjustment or half a year, or do you just do something when events arise?
Yeah, it's something we're constantly doing. So every week or 2 weeks, I would describe it as incremental. There's just incremental adjustments to what we're doing. So to put it in perspective and give a couple of examples, like the energy sector weight that we had in our high income strategy was probably closer to 10% earlier in the year, months ago. Now that's more like 15% of that portfolio. But we grew it from 10% of the portfolio to 15 in half to 1 point increments. It wasn't one swooping change that we just made. And I think that's something that maybe people don't realize, is that it's not something like the light switch you turn off from 0 to 100. These are more decisions that we're just making, subtle adjustments here or there from week to week, month to month, as we see new data points. And there's always a new opportunity coming in that we can decide if we want to take advantage. But then when you look up a year later, it may not seem like much in the short term, but a year later, a fourth of the portfolio has changed. And you've been able to get it switched to a look that you think is more in tune with what's happening at that point in time. But to wait for a huge event for a big changeover, we think that doesn't work as well in practice.
Last chance. Any suggestions to young investors who are watching the show right now and are just learning the ropes? They want to be in your position one day, CIO of a fund, successful, has their strategy intact. How do you develop a philosophy and a strategy? Because you've developed one. Your answers to my questions today demonstrated that, and you're sticking to this principle that you've developed with with Ted Oakley and others at Oxbow Advisors. How does one go about finding this framework for themselves?
I was told this when I first started in the business a lot of years ago. I had a mentor at my first firm I worked for who told me my very first year that the most important thing for me was figuring out what my style of investing was. And the only way you're going to get that is by experimenting yourself in the markets. You can start by having paper portfolios that you're you're not putting actual money on the line, but you're just sort of trying to come up with something, a strategy or an approach that you think might be effective, and you write down some names and then you see how they do. But even that is not as effective as having a little bit. Doesn't have to be a lot. Thankfully, there's fractional share trading at a lot of these different brokers that you can have a portfolio and just be able to play around and make mistakes while you don't have much to actually invest with. And you're going to learn really quickly and figure out, are you a short-term or a long-term investor? Are you a growth investor or a value investor? Are you event-driven? Do you like spin-offs? Do you like stocks, or do you want to stay in fixed income? Do you prefer derivatives? You can try all these different things and start to figure out what is most natural to you. And that was something that it was a decade-long process for me of really trying to hone in on that. And then it starts to get more and more fun as you realize this is exactly where I want to be and how I want to handle the markets.
Great. Where can we follow you, Chance, and your work and the work of your fellow colleagues at Oxbow Advisors?
Yeah, you can look us up at oxbowadvisors.com, or we've got a YouTube channel as well if you search for Oxbow Advisors.
Good. We'll put the links down below. Thank you very much, Chance. Appreciate it.
Thanks a lot, David.
Thank you for watching. Don't forget to like and subscribe and follow Oxbow Advisors in the links down below.